In order for the foreclosure wave not to come, there's some things that need to happen. They may be different than what you think.
Financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Did you know that the Fed fund rate dropped to almost zero by the end of 2008? In less than 1.5 years, the FOMC agreed to drop Fed fund rate 500 basis points. In 2008, the interest rates went from 6.63% for a 30-year mortgage and steadily dropped to a 3.3% in 2012. And yet the bottom of the housing market values didn't happen until 2011. You see, did we still see a crash with the Fed fund rate dropping and interest rates dropping? I thought we would see this wave by now, but it hasn't happened yet. By the end of this video, you'll see that we aren't out of the woods yet. In order to set the scene for this video, we must remember this. One man's spending is another man's income. If we don't understand this basic concept, the rest of this video will make no sense as we look at consumer mindset, then builder activity, and real estate trends towards the end. So make sure you stick around for that. We need to see the Fed print more money. Now, I don't agree personally that the Fed needs to print more money. If they did, that would stimulate the economy again. We saw people spending like they made this money. Then they used it for a down payment on a car, truck, RV, maybe bought the new iPhone, bought a house. It causes more consumption instead of paying off debts. Now, not everyone, I understand that, but a lot of people use that to spend to go buy other things. And this gave people a sense of wealth, which caused spending. Now, we all know what happened. This caused inflation because people were out consuming more and more. Then the cost of things went up, up, up. And when people use this, just that money, that stimulus money, to secure debts, it increased that dollar amount by even more. And I'm not saying that it's wise, but it happened. According to this Fortune article, American savings accounts are at the lowest they've been since 2007. And according to this article, by bank rate, household debt is up higher than before the pandemic. And so that brings us to this next thing. The next thing that needs to happen is the ability to pay off debt or restructure it. When someone has a high car payment or is buried under credit card debt because they went and bought a new couch or remodel a house, they need to be able to restructure that debt by maybe refinancing their home into a 30-year mortgage to make it more affordable monthly, or even sell something that would enable them to pay off a lot of debts. But what we are seeing currently is refi mortgage applications are still down 77% year over year. On top of that, we're seeing people pull money out. Like with the KKR, Blackstone, and Starwood REITs, so many of these investors are pulling their money out that these REITs have had to set a limit on the maximum amount of withdrawals. If this investor didn't make the first round of withdrawals, do you think he's going to panic and try to make it and be the first on the next withdrawal? And if these investors continue to pull out their money from these REITs are going to be forced to sell their real estate assets. But let's bring this more close to home. Banks. Remember that scene from It's a Wonderful Life? When people got scared and they ran to the banks and started cashing out their stocks. And do you remember how he responded? He said, I can't give you your money. Your money's over in so-and-so's house. And your money's in so-and-so's house. And their money's in so-and-so's house. And that's how banks do it. They loan about $9 per the $1 that they have in their banks. And in hard times, people's savings get less. Inflation costs go up. And it's crushing people, which then causes people's savings to get less. Or people get scared and they pull their money out. And this, in return, limits what the banks can loan out. And on top of that, the prices of the products that they're loaning on are starting to lose value. And when they start losing value, banks get more reserved. And you can see this just by going to a local credit union and try to get a loan. This is what we are currently seeing. Cars, boats, RVs, UTVs, homes have all gone down in value in this last year. This potentially eliminates refinances as costs of borrowing go up. This in return brings down the demand, which brings down the price. Just like the price of our subscription. It's actually free. So if you could hit that like and subscribe button, that would mean a lot to us. Spending cuts have to stop. When spending cuts stop for companies and businesses, they won't have to cut jobs, cut overhead, cut off bonuses or extra paid vacation time. But what we are seeing is the exact opposite going on. Big tech has already announced that they're laying off over 56,000 people. And here in Boise, Micron is laying off 5% of their workforce. For instance, Hasbro slashes 15% of its global workforce. Dow just announced that they're laying off 2,000 people. IBM is slashing 1.5% of their workforce. SAP is laying off 3,000 workers. Vacasa is laying off 17% of its workforce. 3M Manufacturing laying off 2,500. Gimini is laying off 10% of their workforce. Spotify is laying off 6%. Alphabet, also known as Google, Wayfair is laying off 10% of their workforce. Capital One is laying off 1,100 positions. Microsoft cuts 10,000 employees. Amazon's laying off 18,000 people. Lending Club, 225, or 14% of their workforce. Locally, builders have put a hold on building spec homes. We drive through these neighborhoods and there's massive amount of vacant lots. Just to give you an idea, look at this graph from Land Pro data. There's about 9,537 vacant residential lots without a permit pulled on them. And if builders have pulled back on spending with buying lots or materials, what does that do to the job market? The reason some of these builders have pulled back is we still have $1.5 billion of vacant inventory. It's an improvement a little bit from last month around this same time. But right now, over half those new construction homes that are on the market, they are priced over $530,000. Let me break this down for you. With a 6% interest rate and having 20% down, that's still a monthly mortgage payment of $2,800. Over half the homes on our market that are listed at $574,000 or more. And let me break this one down for you. With 20% down and a 6% interest rate, that's still $3,000 a month. These people would need to make over $78,000, have zero debt, and have $120,000 that they could use as a down payment. This is why we are seeing homes sitting on the market. Yes, we are seeing homes move, especially underneath that $500,000 price range. We're seeing a lot more inventory move because I'm afraid people are having the FOMO, fear of missing out, and this is your only opportunity. But going back in the very beginning, remember the Fed fund rate dropped from 5 to 0 in a matter of a year and a half, and we still saw a recession. Interest rates slowly declined from 2007 to 2012, and home prices still declined. If you're getting off the sidelines and getting ready to make a move on the market, be patient, be aggressive. And lastly, I want to add, we are trying to follow this trend. Things could change and we might not see a foreclosure wave, but everything's showing that the foreclosure wave is still coming to our area. It didn't come as fast as I thought. I thought we'd be seeing more of it by now, but I still believe that it's going here. But we're going to stay accountable. If things change and they're looking different, we'll let you know. We'll just report it as we see it.